So I am super excited today, everyone, because I am coming to you all live on the ground from my #1 city in America for real estate investment here in 2021. This is a place that the data is telling me is a good place to buy if you're someone who cares about value, affordability, security, cash flow. If you care about those things, which I know a lot of you do, then you should be considering this city for your next home purchase or real estate investment. So what I'm gonna do in this video is I'm gonna take you on a bit of a tour. I'm gonna show you around this city. I'm gonna show you the data, and I'm gonna explain why I think this is a good place to buy in 2021. All right, let's get into it. And before we get into this city in particular, I want to establish some broader context about the US housing market and where we're at right now, because that's going to help inform you about the types of cities and markets that you might want to invest in here in 2021. And the thing we really need to understand is that the US housing market today is in the biggest housing bubble it's ever been in US history. And you can see that reflected on this graph where we're looking at inflation adjusted home prices in America. This takes the typical home price in America and adjusts it downward for how much inflation's gone up. This data comes from Shiller. And you can see that starting from the early 50s all the way through almost up to 2000, inflation adjusted home prices in America were flat, meaning that home prices went up by just about the same amount as inflation, 2, 3, maybe 4% a year. But then something changed around 2000 and we saw all of a sudden home prices go way, way up. They skyrocketed all the way to a high in mid-2006, which I'm calling bubble #1 in mid-2006. Of course, you all are very familiar with this housing bubble, and I'm sure very familiar with the epic housing crash that then occurred in the 6 years prior. And by the time we got to 2012, inflation-adjusted home prices had crashed down to only about 10% above their levels in the early 50s. Of course, we had a rebound in the housing market after that. First, it was gradual, and then it was accelerated all the way up to the point today where now we're back at the highest levels of home prices in US history, according to this Shiller inflation-adjusted home price data. I'm calling this bubble #2. We have never seen inflation-adjusted home prices this high in America, and the only other time they were ever close was in bubble #1. So it's just really important that you guys understand that here in September 2021, we are in the biggest housing bubble that America has ever experienced. Home prices have never been higher relative to inflation and wages. Let me repeat that. Home prices have never been higher relative to inflation and wages. There's a lot of people in real estate who want to hide that reality from you. They want to make you think that the housing market is fundamentally supported and robust. Let me tell you, it's not, and we're going to have a housing crash. So as a result, you need to be very careful about the cities that you buy real estate in right now, because there's some places that I think, some parts of the country, which have 40% price downside from current levels. And clearly, you would not want to buy in those locations. Meanwhile, though, I think there's other cities, such as the one behind me, which will barely be impacted by a national housing crash. Maybe there's a small correction, but by and large, values, I think, will hold in this city. And how do I know that? Well, the best way to understand is to go back to the last housing crash. What were the cities in the last housing crash that didn't get hit hard? And why didn't they get hit hard? This will give us a clue as to why the city behind me is a good one to buy in today. And the best way to get a sense of this is by looking at a metric I call value to earnings ratio. And no doubt if you've watched this channel, you've seen me talk about this metric before. But what we're looking at on this graph here on the x-axis is the value to earnings ratio of all these different markets, these different dots, back in 2007. So what was the relationship of home prices and values in the market to how much money people earned in the local economy? This is such a key relationship because ultimately it's how much money people earn that determines how fundamentally supported home prices are. And we're comparing that value to earnings ratio in '07 to how much home prices declined from '07 to 2012. And what you can immediately see on this graph is that the higher the value to earnings ratio was, the more that prices declined. All of these kind of red shaded dots in the bottom right of this graph: Sacramento, California; Reno, Nevada; Riverside, California; San Diego; Miami; Northport, Florida; Las Vegas. All of these markets had high value to earnings, meaning that prices were really high relative to wages, and thus they had the biggest price declines because there weren't really the fundamentals there to support the prices that existed in '07. So the prices went down. At the other end of the spectrum are the markets in the top left, which are the exact opposite. These markets are low value to earnings back in '07. A place like Pittsburgh, the value to earnings was 3.5, which means that it would only take 3.5 years of someone earning the typical wage to equal the typical home price. Well, in Pittsburgh, prices actually went up moderately during the last crash, as they did in Buffalo, as they did in Shreveport, Louisiana, as they did in Oklahoma City, as well as places like Syracuse, Rochester, Tulsa, San Antonio, Evansville, and Fort Wayne, where prices only went down by a little bit, a couple percent. And why were these markets so resilient during the last crash? Their value to earnings ratios were low, meaning that earnings supported the local home prices. Home prices were affordable enough that even though there was a national housing crash, there was still enough people locally who could step in and afford homes and buy homes. Thus, prices didn't decline. And affordability is so key. It's so key here in 2021 if you're a home buyer or real estate investor to find out if your market is affordable, because that's ultimately what's going to provide the downside protection from the housing crash. Is if your market is affordable, aka home prices and wages, the value to earnings ratio is more closely linked. If you have a good low value to earnings ratio in your market like this market has, you're going to be more insulated from a downturn, just like you were back in the last housing bubble in '05, '06, '07. And right now I'm actually walking around in one of the nicest neighborhoods in this city. This is one of the nicest neighborhoods, absolutely beautiful homes all around me, as you can see. And the great thing about these homes is that they're valued at $600,000, $700,000, $800,000. The nicest homes in the city in the best neighborhood are $600,000, $700,000, $800,000, which means that they are still attainable for many locals and still affordable. Compare that to the nicest homes in the nicest neighborhood in a place like Austin or Boise or Phoenix. Whoop, duck below the branch. Compare that to those areas where the nicest homes are 1 million, 1.5, maybe 2 million. Here, they're still affordable in a good neighborhood, in a good school district, and that provides downside protection for when the housing crash occurs. That means locals in the local economy still have the wages to support prices and step in and buy. If you guys are enjoying this video, particularly me going local to these markets and filming from on the ground, make sure you hit that like button. When you do that, it gets me a bit more exposure on YouTube, which will allow me to produce more of these videos going forward, particularly ones where I go on the road and film from these markets so you can get a better sense of what's going on across the country. This affordability also extends to the more blue-collar working class areas of this city, which I'm in right now, where you can see the homes behind me. These are worth about $130,000, $140,000. And if you're an investor, these could be some great properties to come in and buy as an investment, because the underlying rental rates that you get are pretty good. For one of these homes at $140,000, according to Zillow, monthly rent is around $1,300 a month. So going off the bat, you can have a rental yield on your investment property of over 10%, which is pretty rare in the bubble-driven, mania-driven housing market we're seeing right now in 2021. So this is what affordability offers you in a city: high cash flows, more security on your investment, less of a chance of price declines going forward when the housing bubble finally does crash. But that doesn't mean you just buy anywhere in America where it's cheap. There's a lot of cities, a lot of places across the US that are really cheap that I don't think are good places to buy, quite simply because the underlying fundamentals and growth dynamics in these cities simply aren't there. If you go to a place like Shreveport, Louisiana, or Peoria, Illinois, these are places that are super cheap. Why are they cheap? Because their economies are contracting, and thus I don't think it's a really good place to be as an investor. What you want to do is be in a city like this that combines that affordability with a certain baseline level of economic growth. That's what's going to deliver you the best value proposition as a home buyer or real estate investor going forward. A place that combines, yes, low value to earnings, good affordability, but we also still have a certain amount of growth going on in our economy. And the way I like to thread the needle on this, to find the markets that offer the best combination of affordability and growth potential, is to compare value to earnings ratio, which we have here on the x-axis, the value to earnings ratio in July 2021, data that's reported from Zillow on home values and the BLS on earnings, and comparing it to how much jobs have grown over the last 5 years, and seeing if we can find a market that offers the best of both worlds. So let's start in the bottom left quadrant of this graph. The bottom left quadrant is cities and markets which are affordable yet which have actually lost a significant amount of jobs over the last 5 years. A place like Toledo, Ohio, value to earnings of 3.5, yet it's down 7% on its job count over the last 5 years. That's not very good. So even though Toledo, Ohio, or Syracuse, New York, or Akron, Ohio, or Baton Rouge, Albany, Buffalo, Milwaukee, Lexington, Kentucky, Chicago, even though those markets have good value to earnings ratio in the sense that they're affordable and cheap, we don't necessarily want to buy in them because they're actually, not only are they not growing, they're contracting from an economic perspective. So that's going to make future appreciation potential very difficult if your market is contracting. Conversely, we have this top right area here, which is the exact opposite. It's markets that have really high job growth, but are also kind of expensive from a value to earnings perspective. A place like Colorado Springs, or Phoenix, or Austin, or Ogden, Utah, or Boise. These are high job growth markets, yet they're extremely expensive right now, and locals are priced out. So we don't want to be in those markets either. Where we want to be is in this top left quadrant. This top left quadrant is kind of the best of both worlds. It's markets that are affordable, low VE ratio, with job growth, which is at least in positive territory over the last 5 years and through the COVID pandemic. A place like Oklahoma City fits this criteria, as does Winston-Salem, North Carolina, Birmingham, Alabama, Des Moines, Iowa, Knoxville, Tennessee, Chattanooga, Tennessee, El Paso, Texas. These are places that are still affordable, yet they have positive movement in job growth, which means that their cities are getting better, they're getting nicer, there's more new buildings getting built, the livability is increasing, and the likelihood of future appreciation is better since we're seeing actually positive momentum on jobs and economic growth.
So I have teased you guys long enough. Here for the big reveal. What city have you been seeing in this video? What city have I been talking about? Well, it is Oklahoma City, Oklahoma. You can see it right there. Beautiful skyline. We got a Ferris wheel going on here, as well as a nice sign representing the city. And the reason why I waited to announce the city towards the end of the video is because I suspect if I had said Oklahoma City in the beginning, maybe a lot of you would have turned away, because this city quite simply does not have star power. It's not a sexy name. You don't really hear about it too often in real estate circles. Instead, you hear about cities like Austin and Phoenix and Boise and Tampa, these kind of like supercharged growth markets all the time. And I think the mistake a lot of people are making as real estate investors now is they're still trying to pile into those supercharged growth markets that have gotten so expensive and that are the reason why we're in another housing bubble in America. It's because of those markets. In my opinion, those are the exact wrong places to be buying right now. The places you want to be buying are the ones with more investment security and fundamental strength. Places like Oklahoma City, which might not have the same levels of job growth as in Austin. However, the levels of home prices here are much more closely linked to wages. I've been talking to locals the last couple of days I've been here, and the predominant response has been that yes, while the market, the real estate and housing market here has appreciated a lot in the last year, locals still feel like they can afford homes. That is so important, that locals can feel like they can afford the home. Because that means when the housing crash comes, there will be buyers to step in and support the prices. In places like Austin and Boise, there will be no buyers to step in and support the prices because no one there can afford the homes. And so that's why I really like Oklahoma City, which you can see in the background, as a market to invest in. And what I'm gonna do now is just give you some quick insights on a zip code and neighborhood level so you can understand, if you are coming into this city, what are the neighborhoods potentially that you should target? What are the neighborhoods that you should avoid? Let's get into that.
So on this map, we are looking at every single zip code in the Oklahoma City metro area, and you can see the metro area covers a very large swath of different counties and cities. So a lot of different areas to consider if you're going to Oklahoma City. And what we're looking at on this map is the zip codes color-coded by home price appreciation over the last 5 years. So the areas in red have had higher home price appreciation. The areas in blue have had lower home price appreciation. If we get started and zooming in more to the urban area of Oklahoma City, which is kind of primarily where I was today when I was filming, we can see that there's a lot of red. around this area, particularly in a zip code like 73106, which is a zip code that kind of includes parts of downtown Oklahoma City going through up midtown. We can see that this zip code has seen a 96% increase in home prices up to a typical price of $197,000 today. Very strong appreciation. Prices have doubled over 5 years in 73106. As they have in 73111. In fact, they've more than doubled. 111% appreciation in 73111, 85% appreciation in 73117. If we go south of the river, we can see 70% appreciation in 73119. So lots of high appreciation in these urban zip codes. Now, I would give a word of caution though to anyone looking to buy in these urban zip codes. You'll see that yes, the appreciation is high and the price points are low. Typical home prices of $85,000, $89,000, $87,000. However, be wary of the poverty rates, which you can also see listed on the tooltip here. 32% poverty rate in 73119, 28% in 73106. 29% in 73117. That means roughly 1/3 of the people in these zip codes are below the poverty line, and that is very, very high. And thus, I actually think if you're someone looking to buy for investment security right now, and you really don't want to lose any value in the upcoming housing crash, I would shy away from these zip codes in red that have had high appreciation combined with high poverty rates, because that's a potentially destabilizing combination. It suggests that really the local areas haven't improved that much, and that it's really investors coming in and speculating and bidding up prices. Of course, once the crash starts, those investors can exit very fast and prices go down. Where I would target is more of the areas that are in between. Maybe a zip code like 73116 further north of the city near Nichols Hills. Home prices have gone up by 30% over the last 5 years, a much more reasonable rate. The typical price is $260,000, and the poverty rate is only 6%. In 73116 Nichols Hills. That suggests that the price you're paying today is fairly stable, it's fairly supported, it's backed up by the fundamentals in the neighborhood. If we go further up north towards Edmond, kind of out into the northern suburbs, we can see even lower levels of appreciation. We have the zip code 73034 in blue, only 20% appreciation over the last 5 years, kind of around maybe 3% per year compounded, not very good. But the poverty rate is pretty low at less than 10%. And the underlying incomes are pretty high in this area. So if you were to buy in Edmond, I think you're buying in a location that's pretty secure and that's not going to have a huge dip. So now I'm back in my Airbnb here in Oklahoma City, and I gotta say, I really enjoyed this trip. I really enjoyed putting this video together. The people in Oklahoma City that I met were all extremely nice, extremely hospitable. The city really pleasantly surprised me in a lot of different ways. Lots of new development has occurred over the last couple of years. You can see it especially around the urban area. Lots of new shops, restaurants, bars. And so I think Oklahoma City is really in a good place right now, has good momentum. And I think the future appreciation potential of this city is going to be better than it was over the last couple decades. And I think in the short term, with the upcoming U.S. housing crash, I think Oklahoma City is going to perform a lot better than many other markets across the country, simply put, because home prices are much more closely linked to wages in the local economy. And that's an important indication of how fundamentally supported home values are. So, I wouldn't be surprised if we see a modest correction in Oklahoma City, just because we have seen an appreciation surge over the last year. Maybe there's a correction of 5%, maybe 10%. However, that's going to be much more modest than we're going to see in some of these turbocharged growth markets across the country in Austin, Phoenix, Boise, Tampa. I think these markets have huge downside in their real estate market. So if you're someone who's an investor who cares about capital preservation, maybe investment as an inflation hedge or cash flow, Oklahoma City is the perfect market for that. So dig into it. Additionally, if you're someone who's open-ended on where you want to move and you just want to move somewhere more affordable that's growing, Oklahoma City could also fit the bill there. If you guys enjoyed this video, I ask that you just please make sure you're a subscriber to this channel, as well as hitting the like button. If you already hit the like button, don't undo the previous one, but hit it if you haven't already. I spend a lot of time on these videos, and I love now going on the road to show you guys more of these markets. So in return, just make sure you're a subscriber, hit the like button. Also consider joining the channel as a sponsor. The cost is $5 a month, and you support me financially. You help support me go on these trips, because these trips do cost money to different markets. So if you want to see more of this on the road content going forward, think about becoming a channel sponsor. You can hit the join button below. There's also a link in the bio. All right, everyone. Until next time, this is Nick from ReVenture Consulting. See ya.